Greetings from Finstudy Club. My name is Ankur Kulshrestha, welcoming all viewers to the fifth and perhaps the last example of the current series, wherein we have already talked about the payback period, then we have talked about the net present value, then we talked about the NPV profiles, and one of the selection of the mutually exclusive projects. So this is really the fifth project, or should I say the fifth question, that we need to really think about as to what is there in store for us. So moving on to the question, which we have here. This question states that Apple Computers is investing $1,200 million in iPhone 7s. Now, this is obviously very, very hypothetical. The names of the companies have got no bearing on any kind of, person living or dead. It's like a normal disclaimer, that we tend to give. The present value of the future after-tax cash flow is estimated to be 2,000. Okay, so this is like the PVCI, which is given to you 2,000. And your PVCO is given to us is 1,200. So clearly the net present value is $800. Apple has 500 million shares with current value of $50 a share. The investment is based on new information and is independent of other expectations about the company, which means to say that this $50 a share doesn't include any impact of this announcement. Okay, this is like an important step that needs to be given in the question, because generally your stock market, which is the market price, generally predicts, or should I say builds in the future announcements and the activities. So the idea is that this 50 share is independent so far. The question is, what should be the effect of the project on the value of company and the stock price? Now the relationship, this question, the fundamental is the relationship between the net present value and the stock price. In your net present value is basically the increment in the shareholders' wealth. If you divide that by number of shares, bear in mind that net present value is always at T0. So if you divide that by number of shares, your per share value should move in the same direction and in this quantum. So if I were to calculate this question, your 800 is the perceived increase in the value at T0, divided by number of shares is 500 million. So you have your million getting cancelled by million, 800 upon 500, it is $1.6 a share. So here the value should go up by 1.6, so the value should ideally be 50 plus 1.6 is equal to 51.6. So option A becomes the correct answer. So I think this has been pretty small, straightforward, and interesting aspect. So should you have any question, query, or any aspect which you want us to take up, please email us at finstudyclub@gmail.com. Please also subscribe to our channel on YouTube, which is YouTube at the user column Finstudy Club. We would be posting a lot of interesting videos in the times to come for December 2014 and May 2015 examinations. This was Ankur Kulshrestha signing off for now. Looking forward to speak to you very soon on different session. Thank you very much.